everyone, to Cut to the Chase with Jen and Dan. This is episode 12. My name is Dan Ferullo and my co-host Jen Freed.
Good morning, everyone.
Good morning. So, just after Labor Day, we've kind of getting ready for the fall. The fall is here. It feels like fall outside, actually, unfortunately, which I'm not really loving, but...
I know, I'm taking my last, I think we have like 22 or 21 days of summer left. Yeah. So I'm sticking with my iced coffee. I'm not making the switch over to hot coffee till that fall switches over. No pumpkin spice anything for the record until that time. Like, just not gonna do it. Flip-flops are staying in rotation, just gonna say.
Do you wear flip-flops to work?
Not to work, but they're in the shoe rotation. I'm not going to retire them.
I almost don't even have time to wear flip-flops anymore.
So, well,
maybe on the weekend.
I actually wear them in my house, almost like slippers.
I do that too, actually, I guess. You're right.
Especially going in and out in the backyard and all that kind of stuff. But enough about shoes. That actually should be my other
probably
podcast.
Talk about shoes for like
especially
5 days.
Especially you and I. We have quite a collection between the two of us. But back to school, back to business. So what's our first article today, Dan?
All right. So this morning we're going to talk a little bit about the fears of the recession. So a Realtor.com article, as recession fears rise, here's the lowdown for real estate. So we're hearing that we're expecting an economic downturn, and a recession really is defined as 2 consecutive periods of an economic downturn. I think it's more than like 0.2% or
correct,
something like that.
And some folks say end of this year. Some folks say sometime next year. Some are projecting the following year.
Yeah, who knows really. However, as far as the real estate market goes, in 4 of the last 5 recessions, the real estate or home prices have actually gone up during recessions, and here's why. So when a recession comes, people decide that they may not want to sell, they want to kind of hold off, so there is more of a scarcity of homes on the market, and when there's a scarcity, we know that home prices go up. It's basic supply and demand and basic economics, right?
Exactly.
So the only time that home prices have significantly declined was during the Great Recession of 2008, when the housing market was the cause of the recession.
Yeah, exactly. So I think it's important to keep in mind that when there's an economic slowdown, every industry is affected differently because there are a variety of factors, and no 2 economic downturn are created equal because there's a variety of factors and we're at a different point in time. So it is comforting to know that typically real estate continues to appreciate during those times. It slows down a little bit, but you're still seeing appreciation during that time. It's not like other products. And because people do need places to live, no matter what, they need a roof over their head, they're going to cut back on other things. They're not going to cut back on housing, and so that keeps the market healthy.
So what about rental prices? Do you think rentals probably won't become cheaper either, as some people might expect? They're also saying that apartment price hikes, they will slow from 3% annually to a more minor 1.5% to 2% price increase rent increase over the next year. And actually, is that that's not an article that we're talking about today. So rental market is likely to be buffered by those nervous about making what could be the largest purchase of their lives, buying another house or buying their first house. So people may decide to stay in their rentals longer, but there's not going to be a decline in the rent prices either.
Sure. Well, and it makes sense that, that is a source of income for landlords. So I can't imagine that in a tighter time they're going to want to start discounting their source of income. And especially in the Northeast, we're down to about a 1% supply of apartments, which is almost, you could call it a shortage of apartments.
Truly,
so when there's that little of availability, you don't have to discount because there isn't enough of it. You're always going to have a renter available, even in an economic downturn.
Right. And then talking about builders, so we know that new construction is going up. The prices of it are it's considerably more expensive than it was a couple of years ago to build a single family home. And while we wish that more builders were building more affordable homes, more in the $200,000 to $250,000 range, maybe even under maybe even up to $300,000. Right now, their builders, the prices of new construction are going to continue to go up as well because of tariffs on building materials such as steel. And there's a shortage in construction workers too. So, but maybe if any of those people get laid off, they're talking about potential layoffs during the recession. Maybe if people get laid off, they could be working in construction.
Yeah, from other industries.
I think what might happen though in that case is that the builders will maybe build a house. They'll maybe not be building more spec houses. They'll more just kind of wait until they have a buyer, and then will move forward once they have an actual contract and somebody who's willing to put down, a 10 or 20% down payment to pay for the build going forward, so they don't have that cash outlay. So that could be hopefully what could happen.
Yeah.
So, and then talking about foreclosures, of course in 2008 during that recession, the foreclosures were
astronomical.
Astronomical, yeah, exactly. But I think but right now, homeowners have a record amount of equity, and that's actually something that we're going to be talking about in the next article. And so because people are so stable in their homes, they will have other options if they are not able to pay for their mortgage. They would have more opportunity to just sell rather than, where back in 2008, people owed just as much or more than what they were able to get for their house because of the severe drop in the prices. So like we said before, where we're not expecting that the prices of houses will be going down, that hopefully should not affect most people too. So I think that there will of course be a slight raise in foreclosures, but the number right now, which are already at rock bottom, so of course they can only go anywhere but up, or they can't go anywhere but up. But that shouldn't be such a significant problem. So
yeah, and I think the biggest difference is that the way loans are made much more secure than back in 2008. So
great point.
The risk of foreclosure, folks who would have been in a high foreclosure risk category, they're not being approved for loans. So I think that that's going to contribute to the rate being significantly lower this time around.
Yeah, for sure. So overall, we're hearing that there's a potential for a recession, but as far as the housing market goes, we're not looking at it's not going to be as bad as some people are saying. And
we're just not that.
Don't listen to the
industry.
doom and gloom.
We're not that industry that typically takes a wallop because of the nature of what we do and because of the way house prices work and because our product is something that people always need.
That's true, they do. People do need a place to live. So we'll link that Realtor.com article up in the show notes. It's a really interesting article, so definitely take a look at that.
Yeah, and Dan, occasionally you read the charts about the dates of all those recessions, and folks are like, wait, I didn't know that we had a recession then. So some of them are so subtle as you're going through them, you don't actually know that a recession has occurred or a slowdown has occurred until later somebody points out, so 6 months ago when we had our recession, what recession? Nothing changed in my world,
right, exactly.
So that might very well be the case.
Exactly, and they talk in that article too that we have been experiencing such a long period of growth that we're due for and it doesn't necessarily even have to be a significant decline. It can just be a small decline for 2 consecutive quarters. So that's such a small amount of time. It may not even be noticeable to many people. So we'll see how it goes.
Yeah, what else do we have on
All right,
bracket?
so a CNBC article, homeowners are sitting on a record amount of cash, but they're not really tapping it.
Yeah, so what do they mean by that, Dan? Spell that out for our listeners.
So right now, the collective amount that borrowers could pull out of their homes while still retaining 20% equity. So say they had a $100,000 home, and they owe $80,000. That would be 20% equity for easy math. So the amount that home borrowers could pull out of their homes while still retaining 20% equity hit a record of 6.3 trillion in the second quarter of this year, which is according to a reading from Black Knight, which is a mortgage data technology and analytics company. Sorry, I can't talk this morning. So this tappable equity grew by more than $335 billion during the quarter.
That's just one quarter, $335 billion.
So that means people are paying their mortgages. That means people are paying their mortgages and they're gaining equity in their homes, which is so phenomenal that people are in such stable places in their houses, and people aren't moving as much as they used to. The average that people used to stay in their homes for an average of about 7 years. And right now, they're kind of staying in their homes about an average of 11 years. So it's definitely a more, people are staying in their homes longer, and they're building up more equity for, who knows what they're building it up for, but they have all this equity and they're not tapping it.
It's for a lot of folks, it's the biggest piece of their financial picture.
Yep.
That the cornerstone of their financial plan.
Exactly.
So.
But of course, that equity it's really just it's kind of like the stock market, when you see you've made the money in the stock market, but you don't actually have it until you pull it out.
Exactly.
So it's there, but it's not. But it's not saying that I'm not saying go and pull all of your equity out of your house, of course, and the lenders are not doing as much cash out refinancing as they did in the past too. People, because the economy is so strong, people are in such good places that they're not really needing to pull that equity out of their houses. But it's just a really great thing for homeowners across the country that they're in such a great place right now.
Yeah, and I think you'll see, a lot of that is in the baby boomer generation.
Mm-hmm.
So I think some of that is going to begin to be tapped as people make retirement plans.
Yep.
I think some of it will, after that, we're going to begin to be tapped for folks who want to take it out, downsize their home, and then send children off to college. The price of college has really skyrocketed. Really So the rate of return on housing versus what you can get in a traditional, college investment plan, you can't beat it.
Right.
So I think for a lot of families that was, when the last kid's out, we'll sell the family house, and that's going to be part of that plan. So I think we're seeing the buildup of the funds, and I'm curious to see in a few years down the road, as those two populations start making some changes lifestyle-wise, how this changes that.
Yeah, awesome. And it's certainly is smart to talk, or it certainly is we need to mention too the falling mortgage rates right now over the past several months. So many homeowners are refinancing to get a better rate, but they're not tapping into that equity still. They're just trying to do that to get a better rate, which is great too. So if you own a home and you have not refinanced recently, or even if you have refinanced recently, reach out to your mortgage lender. Or if you want a great lender to talk to, we can certainly help you out to find one to help you to refinance in your home, because I think the average interest rates right now are very low, like 3.5%. So
yeah, and not all of them require you to pay closing costs. There are some programs where there's a no closing cost refi. So some lenders offer that option, which is attractive for a lot of folks who don't want to have to pay a fee just to lower a rate. So know that that's a possibility for you.
Yep, for sure. And then last but certainly not least.
Ooh, this is cool. I love new technology, new ideas.
Yeah. So there is a real estate investing platform called Peer Street. Where did it? Bear with me a second.
This is under the category of fintech for those of you that like all the buzzwords.
which is short for financial technology. Go figure, right?
Yeah, so platforms like Peer Street are the future of real estate loans. And while some of it seems like it would be peer-to-peer lending, it's actually how does an individual person get to use investing in packages of home loans the way corporations can buy them, package them, and sell them to like an investment bank as part of a portfolio of investments, that might go in like your 401k plan, something like that. Yeah. So this is really cool. I love it. It's like crowdfunding for investments.
Exactly. So crowdfunding for, for purchasing loans for, so the program, what they do, they use big data to, where did it go? Sorry. So they, online marketplace for real estate backed loans, crowdfunding for mortgages that break standard loans up into, you just said that, sorry. High-tech data analytics. They shop for real estate debt from reputable private lenders from across the U.S. They review each lender's track record and then run individual loans through their proprietary analytics engine, which uses advanced AI algorithms and data science to curate a pool of safe, high-quality real estate debt investments, and then sell pieces of these loans to investors. So people are buying, maybe 20,000 or small amounts of these loans, and they're getting as much as 10%. They get to earn 10% or more on their investments. So sounds like a really exciting program, a really exciting peer-to-peer program, which at the moment is only available to what the SEC calls accredited investors. So that means that you are an individual with a net worth greater than $1 million or an annual income greater than $200,000. But if you don't fit into that category right now, some of those things might change. In 2015, the SEC officially opened up the crowdfunding marketplace to non-accredited investors. But there are strict rules in place that limit the amount of money that you can invest per year to either $2,000 or 5% of your yearly income or net worth, whichever is greater. So it just basically saying, while right now this is not available to everybody, it's definitely something that they could be opening up and expanding in the future.
I can kind of see that, right? Because it's even in trying to explain it on, the podcast and the video, trying to explain yes, you can sell people's mortgages as an investment to people. It sounds really kind of dicey, but people every day, in fact, businesses, banks, make a lot of money doing this. So this company had a good idea, which is if institutions can make money doing this, then how can an individual make money doing this? So then the SEC says if individuals are going to get involved, there is definitely a risk for people being taken advantage of. So we have to have some safeguards and limitations in place. Because those 10% returns sound excellent.
They do.
But the article doesn't specify, but I would reckon that on the risk meter of investment, this is a much riskier bet. So if you're gonna put your 20 grand in on this, you better be willing to lose your 20 grand on this, but you could make a hefty amount if it works out.
Right.
So a really cool opportunity, but you need to be educated, savvy about it.
Yeah.
But a cool thing that it's becoming something that everyone can partake in instead of just institution to institution. I like that.
Yeah, absolutely.
So, something for the regular guy.
Yeah.
Well, if you have $1 million. So the not,
well, right now, yeah.
The not regular guy, but the, maybe someone that can take on that risk at this point.
Yeah, absolutely. So that's all that we have this week. Yeah, man. If you like our podcast, please throw us a like on YouTube or on the Apple Podcast. Please leave us a comment. We are here to help you guys, so if you want to hear anything, let us know. Or if you have any questions or comments, we'd love to hear them.
Yeah, leave us a star or 5. We like 5 stars on the iTunes rating, and definitely let us know your opinions on some of these articles.
Yeah, for sure. We'd love to hear what you think.
Absolutely. Good morning. We're off to more coffee. Have a good day, everyone.
Have a good one.